Thank you, everyone, for joining the call. In the next 15 minutes, I hope to go through the slide presentation that you should see on the web and take you through really the product concept, really what the design of the product is, and then talk through my portfolio and how I'm positioned at this point of time. So really getting into it, if you look at really the investment concept of global real asset securities, it is really to invest in equities backed by real physical assets. Now, physical assets are things like oil wells, gold mines, factories, and really what we seek to do is look for equities which give us exposure to these real physical assets. The long-term objective of this product is to benefit from the powerful growth drivers of industrialization and urbanization that you see in the developing economies, and I'll show you a couple of slides to make that point. And lastly, the way we try and do that is really to look for companies which have sustainable pricing power through the entire value chain, and we look for companies globally where we believe we can identify sustainable sources of pricing power which could come from an ownership of an asset or an ownership of a process, and we look to identify those companies and own them in this fund. If you look at really the investment opportunity, and the next three slides will just encapsulate what I mean by the fact that there is a lot of growth in the developing markets. This, in my view, is really the theme that matters for all of us for the next 30 to 40 years of our investment careers. So on this slide, I really show you the tube maps of Paris, Tokyo, London, compared to the tube maps of Beijing in 2008. Beijing in 2050 and Delhi in 2011. And the idea of these tube maps is to just show you that if you look at the most industrialized cities of the Western world and compare that to the East and look at Beijing and Delhi and look at the density of those tube maps compared to Paris, Tokyo, or London, you will see that even in this rapid space of growth that you've seen in Beijing or in Delhi over the last few years, they have a long way to grow to catch up with where we see the West at this point of time. So really this is a theme which will sustain us for a long period of time. Behind Beijing, behind Delhi, you have a number of other cities in the East which will continue to industrialize, which will continue to urbanize. So there will be a lot of demand for commodities, there will be a lot of demand for real assets to fulfill this growth dynamic in emerging markets. I was in China recently, and while flying, from one city to another, I was looking through the in-flight magazine of one of the airlines, and it had one of the airport maps of China. And I think it's very interesting because you look at the airport map of China, and there are quite a few airports, connecting the country around, in various parts. If you look at China's square footage or just the area of China, it's very similar to the U.S. So just thinking about the Chinese map that you have, the airport map here, and then comparing it to the next slide, which is the U.S. airport map. And remember that the U.S. airport density is much higher, as you can see from this chart here. But at the same time, you're comparing similar square footage with a population of maybe about 1.5, 1.6 billion in China to about 350 to 400 million in the U.S. So the point really is that any way which you look at it, whether by tube maps or by airport maps, there is a lot of growth inherent in emerging markets. And yes, they've grown very quickly over the last 10 years. Yes, there is some misallocation of capital in parts, but really if you take a long 20, 30-year view, this is a thematic which will sustain us for a very, very long period of time. So really the investment opportunity and the way I invest is really threefold, and I think these are the three important points about this product which I will cover. I look for global themes and global value chains. So really what I'm looking for are themes which I can own in this fund. So if it's rising oil prices, rising commodity prices, water shortages, agricultural prices going up, the industrialization in emerging markets, increased airport penetration in China, these are the kind of themes that I want to own in this fund. And really the way I do that is I try and look for the best plays on a particular theme across the value chain. I also take an active view on the direction of commodity prices. So using Fidelity's research prowess, which is really research around the world, I work with our analysts to take a view on the direction of commodity prices and then try and actively manage the fund, given the flexibility of this approach, in terms of making sure that we have companies in the fund which at times gain from commodity prices going up, but also gain from commodity prices going down. And I think the third point on this slide, which is the daily liquidity point, I think is the most important. The investment theme in real assets has been now fairly well advertised, but the problem that most investors face while trying to get exposure to this theme is that when you think about a real asset, it is pretty illiquid. If you look at property, if you look at an oil well or a gold mine, these tend to be fairly illiquid assets. If you invest in equities, which give you the benefit of the underlying theme, but at the same time also give you the benefit of daily liquidity, which I have when I invest in these equities, I get a little bit of the best of both worlds, which is I get the benefit of investing in the real asset theme. At the same time, I'm not handicapped by the lack of liquidity which you have when you're trying to invest in the underlying in itself. And I think this is a really important point because it allows investors and it allows me to maintain the flexibility of the approach, which I think is unique about this. Clearly on this chart, what you see is a typical commodity price, which is fairly volatile, goes up, goes down. And really what I try and do with this fund is at times take strong views on commodity prices when I have conviction. And this is generally true at turning points. So really, in normal scenarios, one doesn't have a very strong view on commodity prices, and really the fund focuses on active stock picking, which is really the brown shade that you see on the slide. And that's about 60% of the time. What the fund does is really active stock picking, looking for the best companies, growing production, bringing down their costs, managed by very strong management teams who are allocating capital very, very well. And those are the companies that I want to own in the fund at that point of time. However, there are points of times when I have very strong macro views. And at those points of time, I dial up or dial down the macro bets in the fund. So I'll give you an example of that. For example, here you have the iron ore price. So the iron ore price is very low, and I believe that the iron ore price is going higher because of demand supply, because of all the analysis that we've done, maybe demand coming out of the emerging markets or lack of supply in developed markets. I would want to buy an iron ore equity at the low point of the cycle. At the same time, if I believe that iron ore prices are very high, then what I would want to do is sell the iron ore equities and buy something like a steel company or an auto company if I believe that the steel company has pricing power in the sense that it does not need to pass on lower iron ore prices to its end consumer, or if it has to, then the car company actually becomes more interesting because lower iron ore prices lead to lower steel prices. Steel is a big cost for a car manufacturer. If steel prices are going down and your car prices are not going down that much, what you see is a margin expansion for the car company. Its earnings go up, its profits go up, and the stock goes up. A similar example would be on the same slide if you look at the oil price. So if you look at the fund, the benefit of the fund is that because it invests in real assets around the world, oil is part of the remit. And if my belief is that energy prices are really low, then I can buy companies which are levered to rising energy prices. So I can buy exploration and production companies, I can buy service stocks. On the other hand, if I believe that the oil price is too high, which was kind of my belief in March of this year, if you look at the fund positioning, where I thought that the oil price at $130 would start, hurting global GDP growth, I could buy a lot more aerospace and defense companies, airlines, which tend to do very well when the oil price is coming down. And these companies tend to do well when the oil price is coming down because, for example, for an airline, the largest cost for an airline is fuel. It's almost about 40% of their costs. If fuel prices are coming down faster than fare prices are coming down, what you tend to see is that the airlines see a margin expansion, their earnings go up, and the stock price goes up. So actually airlines tend to be the best performers in terms of the stock market when the oil prices are coming out. And I think this example really encapsulates the flexibility that this approach has, which is if you were invested in a pure energy fund, it would be very rare for the energy fund manager to come and tell you, let's sell energy stocks because the energy price is too high. However, with the flexibility of the approach that I have, which is investing across various sectors, I really look for the best opportunities, the best ideas on a global basis. I'm not married to being invested only in energy, only in materials, only in industrials, only in real estate, only in utilities. I can really move across the sectors depending on where I see the opportunities, depending on where I see the valuation upside. And that active asset allocation through the cycle, I think, adds more value than being invested in a single commodity or a single sector fund over time. If you look at slide 12, this is really the investment universe of real assets. It invests in real estate, utilities, materials, industrials, energy, does not really invest in financials, does not really invest in infotech, consumer discretionary. So it gives you about a 50% coverage of MSCI all country world. And really what we are again looking for is equities backed by real physical assets which have the pricing power through the cycle. If you look at the last few slides, really, just a bit on portfolio construction. Given I was involved, since inception with this product, there is a lot of leeway that I have with the way that we designed the product. I can run the product with a much higher tracking error, 8 to 12%. I run it, on a fairly concentrated basis with about 50 to 60 core stocks with a tail of, some high risk, high reward ideas. I can take plus or minus 10% bets in a single stock. My regional and sector weights are unconstrained, so I'm really agnostic whether a company is listed in emerging markets or developed markets. What I really want is pricing power and for that company to be the best play on the investment theme that I'm looking for. So really this is, conviction investing really in the way that we think it makes sense. If you look at the portfolio construction, there are really 4 buckets that I think of my portfolio in. The backbone of the portfolio is really, stocks which I hope to own over the next 1 to 3 years. These are the companies which are typically, run by strong managers, very good assets, which should earn their returns over their cost of capital through the cycle, generating high cash flows, at times giving me good dividend yields. Which I hope to own for a longer period of time. And those are the backbone of the portfolio and the structural positions. Around that, I build the tactical positions and the high risk, high reward positions. So the tacticals are really the ones which I showed you on the previous slide, which is just trying to put in a high commodity view or a low commodity view. I'd argue airlines in general are really bad businesses which you don't want to own through the cycle. But they have a tactical place in the portfolio when you want to play a view that the oil price is coming off, if your view is that the oil price is coming off. So things like that would fall under the tactical buckets. And then the high risk, high reward positions are really, research-driven positions, so small cap E&Ps, miners, interesting companies, which I think have the ability to scale up over time. But because of either liquidity constraints or because of a lack of management tenure, I don't want to make them big positions. And I'm hoping that over time, either the high risk or high reward positions, translate into the backbone of the portfolio, or they fulfill their investment thesis and move out of the portfolio. Now, all of this, the size of the position is really based on the fundamentals, valuations, technicals, and sentiment analysis, really backed by the research that we at Fidelity have around the world. So if you look at the research that I have, over 300 analysts across the world helping me do that value chain analysis, given that I have analysts covering stocks in Australia, analysts covering stocks in Korea, China, the kind of research breadth of coverage that we have in Fidelity, I think really enables us to add value through the entire value chain, look for companies which have pricing power through the value chain. And I think without this research, and because we don't really rely on the sell side in that fashion, and we have our own research doing this, I think it gives us a unique investment edge in terms of how the portfolio is constructed. Slide 15 is really my last slide, and this is what I hope to present to you every time I see you, which is really my report card. And the idea of this is, given that I'm an investor in the fund, so thinking like an investor, I have the opportunity to invest my money in a fund which is benchmarked against MSCI All Country World, in a fund which is benchmarked versus the emerging markets, in a fund which is benchmarked versus China, a fund which is benchmarked versus India, or in a pure energy fund or a pure materials fund. And really what I'm trying to do with this fund is that over a period of time, outperform the subsets that I can invest in. So I will never be the best performing energy fund when energy is going through a very strong cycle like we are seeing at this point of time. I will never be the best performing gold fund when, gold is going through the roof. But over a period of time, if I can manage the asset allocation decision right, then I should be able to outperform a significant subset of the investment opportunities that I have. So if you look at the performance of the fund really since launch, then in spite of the fact, for example, that this fund is invested mostly in developed market companies, if you look at its performance versus emerging markets, versus China, versus India, it has been fairly strong. So really the investment concept of looking for companies which gain from the growth of emerging markets, irrespective of their domicile of listing, actually seems to be working fairly fine so far in terms of the way the fund is done.